Assalamualaikum and hello everyone. First of all, we would like to thank our lecturer and fellow classmates for giving us the opportunity to present our project today. Our project is titled An Analysis of Buy Now, Pay Later, Financial Management. Before we begin, let me introduce our group members. My name is Muhammad Azrai bin Azmi. Next is Fizat Hafizi bin Muhammad Samsi. Then Muhammad Umar Yusof bin Zulkifli. Finally, Muhammad Alif Hashimi bin Muhammad Asri. Without further ado, let's begin our presentation with Muhammad Umar Yusof.
Our group will be presenting our personal financial planning report based on case studies of Buy Now Pay Later, or we call Bnpl. Bnpl has become a popular payment method because it is allow people to buy item first and pay later through installment. Although it is convenient, using Bnpl without proper financial planning may lead to financial problem. Therefore, in this presentation, we will analyze our client financial situation and suggest a suitable financial planning strategy. Now, let me introduce our client. Our client, it is Muhammad Amir Hakim, 26 years old, working as a customer service executive. He is currently working as a full-time and earn a monthly gross income of 3,800 ringgit with a net income of 3,350 ringgit. He is single and currently live with his parents. Even though he has a stable income, he's still facing several challenges because of his spending habits and financial commitments. Okay, looking at his financial situation, the main issue is that he has multiple Bnpl commitment. Around 35% of his monthly income is used to repay this installment, which makes it is difficult for him to save money and build an emergency fund. Besides that, he enjoys shopping on platforms like Shopee and TikTok, prefer paying by installment, and often eat outside. He also does not have a proper monthly budget, which affects his cash flow.
Assalamualaikum warahmatullahi wabarakatuh. My name is Ali, and now I'll be presenting financial planning. Okay, we're moving into the section 2.0. We focus on financial planning elements, specifically tailored to debt management. As advisor, our philosophy here is simple. Managing debt isn't just paying off what you own. Instead, it is about strategically restructuring liabilities to free up active cash flow, eliminating unnecessary digital financial leaks, and establishing immediate velocity and momentum toward true wealth building. To implement this, we must first diagnose my current active liabilities, which are heavily concentrated across three major Buy Now Pay Later platforms. First, he has an atomic debt of 800 ringgit, requiring 200 ringgit a month, with a 3 months remaining, carrying a moderate risk profile and a flat 30 ringgit late fees penalty. Second, his Grab Pay Later debt stands at 1,200 ringgit, taking 300 a month over 4 remaining months, classified as a severe risk due to restrictive 30 ringgit administrative recovery fee per missed cycles. Third, his escalated debt is 1,800 ringgit for his laptop, costing 300 ringgit a month for 6 months, flagged as highly critical due to its 1.5% compounding monthly interest rate. The grand impact of this is severe income leakage. Amir is committing exactly 22.9% of his 3,500 monthly net income strictly to uncontrolled consumer debt. To address this 3,600 bottleneck, we evaluated two distinct strategic frameworks. Strategy A, is a debt avalanche which focuses purely on mathematical penalty rate, targeting the highest interest rate escalator first, while it theoretically saves the most interest over long horizons. It suffers from a painful slow mental reinforcement loop, making it poorly suited for retail and habit correction. Therefore, we recommend strategy B, the debt snowball. This prioritizes liquidating account based on physiological scale, attacking the smallest balance first by targeting the change from Atome to Grab and finally to SP later. Month 1 completely extinguish Atome. This frees up application dashboard cluttered instantly, builds a powerful behavioral momentum, and serves as highly effective tool to curb retail app dependencies. Next, we look at our saving objective and budget reallocation to protect his cash flow. A basic essential monthly outflow are highly optimized at 1,800 ringgit using our standard multiply formula of monthly essential times by 3 months. We establish an emergency capital buffer target of 5,400 ringgit as his target reserve. To achieve this quickly, we transition his budget across two distinct operational phases. In the squeeze phase, running through month 1 to 3, his needs are held at 50%. His flexibles wants are aggressively slashed down to 10%, allowing a massive 40% or 1,400 ringgit to be funneled directly into debt payoff. Once the debt is clear, he enters the recovery phase. From month 4 onwards, needs remain stable at 50%. His wants scale back to healthy 30% and a permanent 20% allocation amounting to 700 ringgit every single month is established strictly for building his saving and emergency wealth reserve. Finally, let's look at the operational math behind our accelerated debt clearing timeline. By consolidating his base contractual installment of 800 ringgit with our strategic discretionary squeeze of 600 ringgit, we create a total repayment velocity of 1,400 ringgit per month. In month 1, we direct 800 ringgit straight to Atome because the balance is only 600 ringgit. The Atome account is 100% liquidated within the first 30 days, leaving an extra 200 ringgit to roll immediately straight to Grab Pay later. In month 2, we clear Grab, we apply his full consolidated power. The 300 ringgit Grab base plus 200 ringgit free from Atome plus 600 ringgit directionary squeeze, this direct and aggressive 1,100 ringgit velocity straight to the Grab, completely wiping it out. Finally, last but not least, in month 3, we target his final liability escalator. He covers the maximum combined financial velocity of 1,400 ringgit directly onto the remaining laptop balance. In exactly 90 days, the entire 3,600 Grab portfolio is completely vaporized, rendering Ame 100% debt-free and ready to accumulate wealth.
Hello everyone, Assalamualaikum. Today I will presenting on insurance planning and retirement planning, which is two essential components of personal financial planning. Insurance planning help individuals protect themselves against unexpected financial losses caused by events such as illness, accident, disability, or death. Rather than eliminating risk, insurance transfer financial risk to an insurance company in exchange for a premium. For our client Muhammad Amir Hakim, who is 36 years old and working full-time, having adequate insurance coverage is important because it protects both his current income and his future financial goals. Without proper protection, a single unexpected event could significantly affect his financial stability. Now I will presenting about why insurance planning is important. There are several reasons why insurance planning is important. Firstly, is provide financial protection against unexpected events such as medical emergencies, accident, or loss of income. Secondly, healthcare costs in Malaysia continue to increase every year. Medical inflation is rising much faster than general inflation, making medical treatment more expensive. Without insurance, individuals may have to use their savings or even borrow money to pay medical bills. Finally, insurance provides peace of mind because it allows individuals to focus on recovery without worrying about financial burdens. Therefore, insurance should be viewed as an important financial safety net rather than unnecessary expenses. Now I will presenting about type of insurance and recommendations. Based on AME financial profile, several types of insurance are recommended. The first is medical insurance, which help cover hospitalization and treatment costs. Secondly, life insurance provide financial support to family members if the policyholder pass away unexpectedly. Thirdly, critical illness insurance offer a lump sum payout if diagnosed with serious illness such as cancer, heart disease, or stroke. Lastly, personal accident insurance provide compensation for injury or disability resulting from accident. By combining these different insurance policies, Amir can reduce financial risk while protecting both himself and his future financial responsibilities. In conclusion, insurance planning is the foundation of strong financial plan. Although Amir is still young and healthy, purchasing insurance early allows him to enjoy lower premiums and broader coverage. Insurance should not be viewed as an expense, but rather as an investment and financial security. With adequate insurance protection, Amir can confidently pursue his long-term financial goal while knowing that unexpected events are less likely to disrupt his financial future. Now let's move on to retirement planning. Retirement planning is the process of saving and investing during our working years to ensure we have sufficient income after retirement. This has become increasingly important because Malaysians are living longer, healthcare costs continue to rise, and inflation reduces purchasing power over time. Although EPF is the primary retirement savings scheme in Malaysia, it may not be enough to support a comfortable retirement. Therefore, financial experts recommend starting early and building additional retirement savings through other investments. For Amir, who is currently 26 years old, he has a valuable advantage of 34 years before reaching retirement age. This gives him plenty of time to grow his saving through compound returns. Amir retirement planning focuses on four main goals. The first goal is achieving financial independence so he can support himself without relying on family members. The second goal is maintaining approximately 70% of his current lifestyle based on his monthly income of 3,800 ringgit. He will require around 2,660 per month during retirement. The third goal is preparing for increasing healthcare expense as he grows older. Finally, his retirement savings should be able to protect against inflation, ensuring his purchasing power is maintained. Based on this assumption, Amir should accumulate at least 638,400 in today's value before retirement. Since inflation is ignored in this estimate, the actual amount required will likely be much higher. To achieve these retirement goals, Amir should adopt a diversified investment strategy. The foundation remains EPF, which provides compulsory retirement saving through employee and employer contribution. To strengthen his retirement fund, he should contribute RM200 per month into a private retirement scheme or PRS, which offer professionally managed investment and potential tax relief. He should also invest RM200 per month in unit trust fund to benefit from long-term capital growth and diversification. Finally, investing RM100 per month into exchange trade funds or ETF provide low-cost market exposure and support long-term wealth accumulation. Overall, Amir voluntary retirement investment total RM5 per month, which is approximately 30% of his gross monthly income. This fall within the recommended retirement saving rate of 10 to 50%. In conclusion, Amir is in excellent position to begin building his retirement wealth. His young age gives him a long investment horizon, allowing compound growth to work in his favor. By continuing his EPF contribution and consistently investing an additional RM500 each month through PRS, unit trust, and ETF, he can build a diversified retirement portfolio that reduce inflation risk and increase long-term financial security. It is also important for Amir to review his retirement plan every 3 to 5 years or whenever major life event occur, such as marriage, purchasing a home, or receiving a promotion. To conclude my presentation, I would like to leave you all with this important message. Start early, save consistently, invest wisely. These three simple principles can make a significant difference in achieving financial independence and enjoying a comfortable retirement. Thank you very much from me, Muhammad Azrai. I will pass to my colleague for the tax relief. Thank you.
Assalamualaikum and hi, my name is Fizat Hafizi and I will act as a financial advisor to our client, Mr. Muhammad Amir Hakim, and I will focus on advising him about tax planning and estate planning. First is tax planning. Tax planning is one of the methods to customize your financial affairs in a legal and efficient way to minimize tax liability while complying with the tax law. Why is tax planning is important? First, the main purpose is to lower tax liability. Second, it is also one of the methods to improve saving. Lastly, in the long term, it can protect our financial wealth efficiently. Next, I will explain some of the tax relief that are qualified to be implemented by our client. First, EPF contribution. As we know, our client, Mr. Muhammad Amir Hakim, is 26 years old and work as a customer service executive. As a full-time employee, Mr. Muhammad Amir Hakim is obligated to contribute to the EPF. So basically, he is eligible to optimize his tax relief amount legally. Second, Mr. Muhammad Amir Hakim also can take out a personal medical insurance or takaful as one of the tax relief method. Third, Mr. Muhammad Amir Hakim can claim tax relief by purchasing laptops, smartphone, sport equipment and books which are qualified under the lifestyle tax relief. Last but not least, private retirement scheme. By contributing annually to private retirement scheme, Mr. Muhammad Amir Hakim can enhance his long-term retirement planning and also to lower his tax liability. As the expected outcome, Mr. Muhammad Amir Hakim will pay lower taxable income and leaving him with more disposable income. This also help our client to achieve faster debt repayment and secure better long-term financing. Next, we move on to estate planning. Estate planning is the process of planning how a person's asset will be managed and distributed if they pass away or become unable to manage them. For our client, Mr. Muhammad Amir Hakim, although he is still young and has not accumulated many assets, starting estate planning early is important because it helps ensure his assets are distributed according to his wish and avoid legal issues in the future. Here are some main estate planning tools that can be applied. First is a will. A will is a legal document that states how a person's assets should be distributed after death. It helps ensure that the assets go to the intended family members and lower the possibility of family dispute. Second is nomination. Mr. Muhammad Amir Hakim also should nominate his family member for his EPF account and any life insurance policies. Third is a trust. Although it may not be needed at this stage, it can be considered in the future when he owns more assets. Since the client is still single, I personally suggested that his assets such as EPF saving, insurance policy benefit, and personal saving be allocated to his immediate family members. As the client build more wealth in the future, he should keep his estate plan up to date to ensure it meets his latest needed and wish. In conclusion, by prepare a will, making a proper nomination, and updating his estate plan, Mr. Muhammad Amir Hakim can protect his asset, secure his financial for his loved one, and support his long-term financial goal. That's all.
In conclusion, Bnpl can be a useful payment method if it is used wisely. However, relying on too much on it may create a financial difficulties and affect to long-term financial goals. Through this case study, our group has proposed several recommendations to help the client improve his financial situation. And we believe that with better financial discipline and proper planning, the client will be able to reduce his debts, improve his saving, and achieve better financial stability in the future.